Want to know how investing in bonds could secure your financial future? You're in the right place. Hi, I'm Professor Best, and today we're diving into the world of bonds, an essential asset class that often gets overshadowed by stocks. So, let's break this down in simple terms. Imagine you need to borrow money. You could go to a bank, but what if a friend offers to lend you some cash instead? That's basically how bonds work. When you invest in a bond, you're essentially loaning money to a company or government in exchange for regular interest payments and the return of your principal at maturity. Now, you might be wondering, why bonds? Well, let's talk about the first big advantage: stability. Think of bonds like a reliable car, steady, safe, and built to last. They're generally less volatile than stocks, which can feel like a roller coaster ride. In times of market turmoil, bonds can help cushion your portfolio and provide consistent income. But not all bonds are created equal. Here's a quick breakdown of the different types. Government bonds. These are like the golden ticket. Issued by governments, they're typically very safe. U.S. Treasury bonds, for instance, are backed by the full faith and credit of the U.S. government. Corporate bonds. Investing in a company's bond, you're essentially helping them fund their projects. The risk can vary. Bigger, well-established companies are generally safer than smaller, newer firms. Municipal bonds. These are issued by states or local governments. They often come with tax benefits, making them appealing to certain investors. Now, let's dive into how to actually invest in bonds. It's not as complicated as you might think. First, assess your risk tolerance. Bonds can vary from ultra-safe government bonds to riskier corporate bonds. If you're more conservative, focus on government or high-grade corporate bonds. If you're okay with some risk for potentially higher returns, explore lower-rated corporate bonds. Next, consider your time horizon. How long can you afford to tie up your money? Short-term bonds mature in a few years, while long-term bonds can take decades. Aligning the bond's maturity with your financial goals is crucial. Now let's look at the interest rates. Bonds are inversely related to interest rates. When rates go up, bond prices go down and vice versa. If you think interest rates will rise, you might want to stick with shorter-term bonds to minimize risk. To invest in bonds, you can buy them directly through a brokerage or through a bond fund, which pools money from multiple investors to buy a diversified mix of bonds. This could be a great option if you're just starting out. And speaking of starting out, let's say you have $1,000 to invest. You could buy a few government bonds or invest in a bond fund that offers exposure to various types of bonds, giving you diversification right out of the gate. Now, before we wrap up, here's a practical tip. Keep an eye on your bonds. Just because you've invested doesn't mean you should forget about them. Regularly review your portfolio to ensure it aligns with your financial goals and market conditions. So, what's the takeaway? Bonds can be a fantastic addition to your investment strategy, providing stability, regular income, and a safe haven during turbulent times. They're not as flashy as stocks, but they play a critical role in building a balanced portfolio. Are you considering investing in bonds? Or do you have any burning questions? Drop a comment below. I'd love to hear from you. And don't forget to like and share this video with your friends who might need some guidance in their investment journey. Next time, we're going to explore a different asset class you might not be paying attention to. So stay tuned.